Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to just do another velocity banking video. And if you didn't know, I was actually in California for the past month, just on vacation. Finally have come home to Atlanta, and I'm going to show you this is how we do velocity banking here in Atlanta. Okay? So if you don't know what velocity banking is, all it is a simple strategy to help you pay off debts quickly and manage your cash flow. Okay? And I've made a ton of videos on this, and here's the thing. I'm going to keep making videos because that's how I know I'm going to get better at strategy. I don't know if you ever heard the quote from Bruce Lee. I fear the man who does 10,000 kicks, or I do not fear the man who does 10,000 kicks once. I fear the man who does one kick 10,000 times. And that's what we're going to do. We're going to keep practicing strategy over and over again. So there are two requirements to doing velocity banking. Okay. And what are the two requirements that we always talk about? The first requirement, and I've written it down here, is we need a budget. Okay? So I have this simple budget. I put average American here. Household income on average is about 70 something K. I read this in the census, but for now, we just want to make an easy number. We'll say $5,000. And if you were this person, let's say we just had three credit cards, right? Three credit cards that equals, I think, 50,000. And we had a mortgage, yeah, because we got decent income from making 80K a year. And we got some living expenses, $2,000. Would you freak out if you had all of this debt and only had $362 left over in your savings? I think I might, right? So what's an easy way where you can pay off this debt and not even really think about it? Okay, and that's what we're going to do. So we have our budget. And so one thing to note about our budget is that our goal is to pay off these debts, and every debt that we pay off is more cash flow for us. So that's essentially the name of the game, more cash flow. Okay, and we're going to make an assumption. So two assumptions. One, we're going to make the exact same income. Okay, so no more strategies that require us to make income, even though more income would be great. But for all of our examples, we assume we have the same income. And the other thing too is we're going to not have savings. Now I know that in some households that's taboo. In fact, my mom thought I was crazy because I told her I have nothing in my checking savings, right? I don't know about you, but I've had $0 for my checking and savings for the past like 2 years or so when I learned about that strategy. So the strategy is, okay, we have to select our main operating account. And our main operating account will be called this thing called the line of credit. So we did the budget, where we kind of half did it. And then now we need to select our operating account as a line of credit. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. So credit card counts as that, right? That's a line of credit. We also got personal, business, home equity lines of credit. Um, Here's the thing. If you own a home, you could probably get a home equity line of credit if you have enough equity. What's equity? All it is your home sales price. Like if you're going to put a for sale sign in front of your home, minus, okay, minus all of your debts tied to the home. So in this case, it's a mortgage. So let's say, okay, the home sales price for a sell our home today is going to be like 300,000, okay, and the only debts tied directly to the home is the mortgage. Okay, so 200,000. What's our equity? 100,000. Now banks like to lend you money based on the value of your equity, usually 80 or 90%, right? So what we do is you take your equity and then multiply it either by whatever percentage or ratio that they're using, and I'll just do this. So if I do 0.8, then they'll lend you up to $80,000. Now, I have had two home equity lines of credit. So my first home equity line of credit was only 15 grand, right? And then I reapplied the next year and I got a 50 grand home equity line of credit. And I think if I reapplied either this year or next year, it'll probably be like 150 that they'll lend me at least because I have an insane amount of equity. In fact, I probably shouldn't tell you this, but I think I have over like, if I were to sell my properties today, at least I get $250,000 in equity. And again, I don't need to sell my properties because I don't need the money, but it's good to build wealth. So what I'm going to do is we're just going to assume here that this person has enough equity just for a simple 25 grand line of credit. Okay, so 25 grand. Well, actually, you know what? Let's just make it a little bit easier on ourselves. Let's say 30 grand. Okay, 30 grand line of credit at a 10% interest rate, because that's usually, in my experience, what home equity lines of credit goes for, especially if it's second position. I don't know about first position. I heard that first position home equity lines of credit are actually have cheaper interest rates, but I'll have to take a look into that because I've only had second position. But let's say we have a 30 grand, kind of like a credit card based on the value of your home. Okay, and they actually mailed me like a card, and I called them the bank. I said, "Hey, is this a debit card or credit card?" They told me it was a credit card for the HELOC. Okay, so just kind of think of it as a credit card based on the value of your home equity. Okay, so let's do this. Now what we have to do is first let's quickly go over strategy. Put your entire paycheck into that line of credit, take out your expenses, rinse and repeat over and over again. And you might say, is it that simple? Yes, it is that simple. Okay. So now what we have to do is just transfer some debts that we have, right? And the more debt that we transfer, guess what? The more cash flow we free up, and that's the name of the game. Okay. And so you might be thinking, which debts do I transfer? Do I transfer the 5,000, the 15,000, or 30,000? I would say in this case, let's just make it easy on ourselves. Let's transfer the high interest rate debts. Okay, so it's 5 and 15. So this is what we can do. Actually, let's do this, right? So let's transfer $30,000 up to here, and this is actually what we're going to do. Okay, we'll transfer this $20,000, pay this off, and guess what? This becomes zero. This becomes zero, and then what we'll do is we'll actually make this into a 20K, right? So we'll transfer 10 more. So this is 20. This is transfer 10, and now what we have to do is take a look at what the monthly payment would be, and we could do that by going to bankrate.com. So bankrate monthly, well, I'm sorry, credit card min calculator, minimum payment calculator. So we're going to go ahead and do this. And what's our credit card balance? I'm sorry, I'm just going all over the place. It's 20K at 18%. And some of you might be surprised if there are 18% credit cards. There actually are. In fact, I think I got one at a credit union that was at that interest rate. I'd have to check all my interest rates because they do change from time to time. All right, so $500, 18%. So now we got to go here and then just put in $500, okay? And now our mortgage and our other costs, we'll just assume that they stay the same. And let's just copy and paste this formula. And then now let's figure out our new cash flow. So it's C2 minus C3. And take a look. Before, when we were the average American, we were sweating because $300 of savings a month. Like I told you guys, I don't have any savings, right? Because I'm putting all the power of my entire paycheck into that line of credit. And because I'm transferring debts the right way, it just, my cash flow exploded and I didn't even pay off any of my debt, right? So let's just assume this is the first month that we do it. So again, just memorize this formula if you don't understand. You always want to get the previous months, right? So G2 plus H2, right? And again, even though there's no interest, and after the first month, there's going to be interest, okay? And so get the last balance, get the interest, and then minus your cash flow. So that'll be 1,300, okay? All right, so we got that. And then after every month, we're going to have to calculate the interest. So let's go ahead and do that here. Get the average of the two. I don't know if you know how the interest is calculated, but they calculate through the average daily balance. So you can just do average G2, G3. It's just actually the midpoint, so it's not actually the average daily balance, but this is good enough as an estimate. Multiply it by 0.1, which is 10%, and then you divide by 12 to get the monthly interest, okay? And this is what you do. Once you set those formulas, you just copy it and paste it until you see like red, right? And that means, actually, we can actually do this, okay? We could either pay it off to zero or actually move this 20K, and it's probably not going to be 20K by then. And we could just take a look as to what this will be after 11 months. So we could actually keep transferring the debt from this 18% to the 10%. Okay, But let's just check at month 11 what this 20K balance is, right? We show the payment schedule, month 11, 18 grand. 18 grand. So let me just check here. So 18, we only paid off 2 grand. Ooh, yeah. Well, let's just do it until we have enough room to fill in the credit line. But usually what I do is just say this, copy and paste until like it goes to a red number, right? And this means the credit line is entirely paid off. But why don't we look for a point where we could still move the rest of the balance and see if we can do that. But let me just check. So let's see. At 18 months or 18 payments, so let me go here, 18 payments, 16 grand. Can we move it there? Let's see. Can we move 16 grand here? Yeah, we can. So let me just see at 14 payments. What is it? 14, 17. No. And again, this is just me kind of guessing. 15, 13, right? So 15 is 13. Almost there. So let's just do one, maybe, yeah, 16 or 17. Definitely 17, I think. So let's just take a look at the 17th payment. 17. And this is our new balance at 17 months. Yeah, we could definitely do it then. So let's just say month 17, we're going to transfer how much? 16, almost 17 grand of debt. Okay? So let me just do this, month 17. I'm going to go ahead and highlight this, right? And then let's go ahead and transfer this here. Okay? And, you know, if I were to actually do this in real life, I'll be honest with you, okay? I would actually probably fill this brim like to the 30K every single month. I probably would, but just for the sake of the demonstration, I'm just doing it at one go or chunk. And then what would happen here is that once that's been transferred, guess what? This thing is zero. Now, here's the unrealistic thing. Every time you make a credit card payment, this actually goes down little by little. I mean, if you take a look here, right, you see that the minimum payment, unlike an amortized loan, is not fixed. It just goes slightly down in a line of credit. Whereas with, so that's why some of this is unrealistic because this isn't going to always eat your cash flow at 750. After every single payment, it's going to go down a little bit. But here, with the mortgage, the 1200 is always the same, whether you're in payment 1 or payment 360, okay? So just be aware of that. All right, so now here we can calculate our new cash flow. So what's our new cash flow? 1800. Oh my goodness. All right, so now let's go ahead and do 1800 right here. And then what we're going to do is just kind of copy and paste this, right? And now take a look at that. So 34 months, okay? So let's write some milestones here. Milestones, right? So again, not bad. 34 months. And how much? 50K of debt. 50K. So let's see, 34 divided by 12. That's 2.83 years. Okay? It's not bad. Again, I've done 58K in 1 year, right? So always think about two things, reducing your debt and making more money, right? And then that will really speed up your debt process. But again, if you're in this situation where you're only making like $300 savings a month, you know, 34 months of 50K is like mind blown, right? But in my world, I paid 58K in 1 year, and that was my mortgage. Okay, but again, to each their own. All right, so now the last one was we'll just tackle on the mortgage. Okay, so now at this point, the mortgage is the last debt you want to pay off, and this is how I would kind of phrase it. Would you pay $200,000 just so that you wouldn't have to pay $1,200 a month? And you might think that's a lot of money just to get $1,200 a month, right? And that's why, you know, in terms of the ratio of the balance of the loan compared to the payment, this is why the mortgage is absolutely dead last in terms of the order of you pay off. Also, the interest rate as well, you have to take that into account. Again, we talk about this in other videos about like how there's certain measures of what to pay off, the cash flow index, blah, 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 blah. If you want to look at more information, look up cash flow index on Google. Okay, so now we have a $200,000 mortgage. Let's go ahead and look at this amortization calculator right here for this 30-year mortgage at 6%. Okay, and our payment is about, I round it up, but it's $1,199.10. And so now what we have to do is figure out after, I think, 34 months. So 34 months, where are we at in the mortgage balance, aka the mortgage principal? So 34 months, 192K, right? So 192K. Okay, so now you know what's crazy? Okay, so this is the end of year 2, almost at end of year 3. So let's take a look at how much interest we're paying at the end of year 3 at a 6% mortgage. We basically paid a little bit over 33 grand in the first 3 years, yet the principal is only about 6 grand, right? So the payment schedule is whack if you're just going to according to the bank schedule and never making more than the monthly payment. So what we want to do is make sure that we're able to pay more. And there's 2 ways to do this, okay? So the first way is the way that is by default available to everybody. You don't need a line of credit to do this. In fact, this is the method that everybody has, but they never do, which is just pay your mortgage directly with your savings. So let's say like you have a savings of 1,800 every month. You could pay your mortgage directly and you'll save a ton of money, right? But the question is, why doesn't everybody do that if they know it's available to them? Because they know that if they directly pay the mortgage and there's an emergency, okay, then they can never really get that money back, right? So I know I've had student loans before, and I was definitely afraid to overpay them. In fact, for some reason, I was definitely afraid to overpay my credit cards too. I think it's just a fear of maybe an irrational fear that once my bank account savings or checking is zero, then I have no access to the money. But hey, that's what the line of credit is for, and this is what we can do. We can force ourselves to pay off this mortgage using our line of credit, right? We don't have to do the entire thing, and then putting our entire paycheck and using our cash flow to pay off the line of credit. Now, why would we do that? I will say, this is just my opinion. The number one reason why we would do that is 2 things. First of all, we don't have to have the fear that we directly overpay our loan, that we're not going to get our money back, right? The other thing too, which I haven't discussed in this video, is that it prevents something called segregation of income, which is why most 6-figure people are broke. So I don't know if you ever read the statistics, but it says that people who make over 6 figures, 50% of them are broke. And the reason why they're broke is because they don't have like 1 or 2 loans. They have like 10 credit cards, 4 loans, like 2 car loans, and a mortgage. In fact, somebody sent me their details, financial details, that had 14 debts on it, right? And what segregation of income is that your paycheck goes into, I'm sorry, goes into your checking account, then your income gets split in, let's say, 14 different ways. And what happens is because you're making minimal payments on every single one of them, uh, the depths just mentally go down, and it's you'll eventually get to a point where you feel like you're drowning, even though you make over 6 figures a year. Okay. All right. So we got that covered. All right. So now, one of the ways that we can quote prepay the mortgage with our line of credit is just make transfers, maybe based on our monthly salary. Okay, and then just use our cash flow to pay it down. So take a look at this. So let's say that we just transferred $5,000 of debt, even though it's a higher interest, right? So the interest is not what we're too worried about. We're more worried about the cash flow, but we just kind of use it as a tool to prevent segregation of income and help us easily pay this. Okay, so 192, and if we subtract 5 from 192, that's 187K. 187K. Okay, so let's take a look here to see how long it takes us to get to 192 to about 187, right? So it's almost 2 years. I'd say a little bit before 2 years, but 187. Yeah, so definitely we kind of accelerated 1 year, and then almost about 5 months in, right? So 1, 2, 3, 4, 5. So 1.5 years, but let's see how long it'll take us to pay this off with our line of credit. So again, how much do we transfer? Just $5,000, right? So what we just do is just do this plus 5000, and then we just kind of keep repeating and paying off with our cash flow. And as you can see, it only took us 2 months to just pay this principal off, right? And if we just went to the bank schedule, it was going to be 2 years, right? So it was, yeah, almost, wait, yeah, year and a half, right? So we're at 192, and then we're going to 187, so about a year and a half, okay? So 2 payments or a year and a half, so it's up to you, okay? So, all right, so now here's the cool thing. I actually have a cheat sheet calculator to accurately or more accurately determine than this method how this would pay off, because the tricky thing about this is that this is not accurate because, yes, it took 2 months, but you're still making payments while you're paying off your line of credit. So our cash flow is an increase. Just be aware of that. So, okay, so now let's go back, and I just want to introduce you to this cheat sheet I have access to. So if you didn't know, I actually learned velocity banking originally from Renatus, and they, if you're a Renatus student, they actually provide this cheat sheet for you. And I'm actually an independent contracted marketer, so I sell their products and stuff. So if you ever enroll in their classes, then you get access to this cheat sheet as well, or I call it a cheat sheet. And so what you do is just enter in this information. So I'm going to put in $200,000 as the original balance right here. Okay. And then what's the current balance? The current balance is, we'll just assume that we're still at 34 months. So it's 192K, 192,000. Interest rate is 6, 30-year mortgage, and let's see, 1199.1. 1191.1. And then all we have to do is just chunk, our paycheck amount. We don't have to make big chunks. Again, at this point when we have the last mortgage, the real benefit to this is to help us prevent, pay it off quicker and prevent segregation of income. That's a big word that I'm going to repeat over and over again when it comes to like your last debt and paying off, like, big debt like your mortgage and paying it off. All right, so now we'll just do this. 15. What's our interest rate? It's 10%. What's our monthly income? 5000. Okay. And then our living expenses. So if we take a look here, what's our living expenses? It's just 2000. We include everything except the mortgage because the mortgage is already taken into account here. So now what we do is 2000, right? And then take a look at that. 6.5 years, right? Look at how much interest we potentially saved. And we're only paying 40K instead of the 200, right? Or 195K. So it's pretty good. So 6.5 years. So how much is 6.5 years? So actually, let me just do this. So 34 divided by 12, okay? And then this one is going to be 6.5 plus 2.83. Whoopsie. 2.83. I'll just, 2.8 is good enough. So all of our debts are paid off in 9.3 years. Okay? So 9.3 years, and then guess what happens? Bam, this is zero, right? So now we have $3,000 of real cash flow, and we got everything paid off in 9.3 years. Now, it's funny. In my world, I'm sorry. In my world, this is too slow because I paid off 25% of mortgage in one year. So, I like to say this is 4 years, right? But, to each their own. But this is way better than the average American, because when does the average American pay off their mortgage? Probably 52 years because of all the refinances and stuff. So yeah, so that's pretty much it for today. Again, another video on doing velocity banking. This is how we do velocity banking in Atlanta, right? But whether you do it in Atlanta, California, Just as long as you have access to a line of credit, then you're good. It doesn't have to even be a home equity line of credit. All right, so this is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google for a link below. Other than that, have a great night, and we will speak next time.